Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita in studio in New York. Welcome back. It's great to have you here. So let's get you everyone up to speed on this market action because we've been looking at a mixed day. We're now looking at the Dow and S&P both in negative territory. The S&P falling back into the red after briefly touching a 9-month high. The Nasdaq, though, barely holding on to gains. The big story, though, of this afternoon, let's get right to it, and that's the latest coming out of Apple. Apple's Worldwide Developers Conference kicking off earlier this afternoon. We got a couple of big announcements here from the tech giant, and among them was this long-awaited headset that we're looking at right now on the screen. Lots of skepticism from some on the street and also I think from consumers about whether or not this was going to live up to the hype. This one called the Vision Pro. Akiko, what did you think of it?
Yeah, I mean, we've been talking about it enough, right? We finally got to see it, but in many ways, this is, at least most are hoping, Apple's definitely hoping that this is going to be the big bet that allows Apple to move beyond just the iPhones and the iPads. And you could argue, because it's a mixed reality headset, not like the VR headsets we see from somebody like Meta, it does allow you to integrate reality and maybe allows for a stepping stone into full virtual reality. You think about what Apple has, their long list of products. It has the overlays with the apps. It allows you to communicate maybe potentially through FaceTime. I mean, there's a number of things that they unveiled here that, at least for me, seems to make sense. But to the point you made off camera, it's still really bulky. And you have to wonder how much people are going to take to it with the size as well as the cost.
Yeah, exactly. And I think cost is huge. And to that point, it was interesting to me that within this announcement, there's been some talk just about Apple emphasizing business uses. And I think that's key just in terms of this potential success of this product, given the fact that we are expecting this to cost so much. I still have lots of questions about how popular this is going to be among consumers. One, given the price tag, obviously, but two, just the comfort level and how open people will be to using a product like this. We know others, like Meta, for example, has not been successful with its headsets. If any company, though, is going to do it and make it quote unquote cool, it's going to be Apple. So they do have that going for it. One of my favorite parts of this part of the presentation when we were talking about the headset was how it could be used when you're watching games, when you're watching sports. And that's really one of the areas that I think could potentially revolutionize the user experience as well as also the entertainment industry as well with Disney.
Well, and we heard Tim Cook say specifically it's the first Apple product you can look through and not at. And we do have a price tag here right there. $34.99. We're talking about $3,500, and that's going to be the real test for Apple. How many people are, willing to shell out that kind of money? It is about the content, though. As we've seen, at least with VR headsets that have been released from the likes of Meta, the content hasn't necessarily followed. You'd imagine with Apple, with all the products, with everything they have in place, this is the way that they can at least make it a little more mainstream.
Yeah, I think they will be able to make it a little bit more mainstream, and also with Iger there on the stage talking about Disney, the partnership with Apple, how that is going to really be something that most people can relate to. It's just one of the ways that Apple is so good at something like this and could potentially be convincing people out there to spend $3,500 on the device.
Yeah, and of course we're going to be watching the stock reaction on the back of that too, because we did see Apple hit a record high ahead of the event, giving back some of those gains, and it is now down about 0.5%. We're also keeping an eye on markets and Apple shares with the ongoing event. Yahoo Finance's Jared Blicker is on the floor of the New York Stock Exchange. Jared, what else are you watching?
Yes, well, let me just stick with Apple for a second because some pretty interesting developments. I was watching the presentation. By the way, this is a long one today. If you look at the Wi-Fi Interactive, I have the intraday price action mapped out, and there was a bit of a decline coming into the opening remarks here, and then we really saw a big sell-off. That big down red candle, that came off on the announcement of the headset. Is that ominous? I think it's a little bit too early to tell you, but I think it's notable too that, as you said, Akiko, Apple had climbed to a record high just before that announcement. And if we take a look at a 2-year, let me see if I can bring this up. Here's a 2-year chart. You can see Apple has been on just a tear, really earning its weight within the S&P 500 and the Nasdaq 100, helping the Nasdaq to outperform the way it has. And Apple's not even really an AI stock. There's a ton of AI embedded in Apple products, but not to the degree that Microsoft and Alphabet have really pivoted there. So enough about Apple. Let me just get to our heat maps for the day, because as I was talking about, Friday was with that non-farm payroll, was really a pivotal day in terms of the price action. We saw this huge spike up in the Dow as opposed to the Nasdaq. The Dow basically doubled or tripled the Nasdaq's performance, and that's something we haven't seen quite a bit. Now here, you can see today is kind of the flip of that. We have the Dow down the most, that's down about 0.5%, Nasdaq down about 0.25%. We'll have to see how this plays out, but it looked for a second on Friday like almost like November of 2020 with the new infrastructure play coming out. So not seeing any hints of that right now, so maybe it was just a one-day price action, but I think traders are going to be looking ahead, especially towards next week's CPI and the big Fed announcement. Are we going to see any hiccups around those reports? Because remember, it's about jobs and it's about inflation, and anything else is just kind of not getting as much attention nowadays. Finally, here's a sector action on the S&P 500. Going to check out some heat maps here. Healthcare in the lead, followed by materials, communication services. It looks like utilities as well, but really not seeing a lot of outperformers here. Industrials, which was one of the big cyclical moves that we saw Friday, that is getting reversed. Industrials XLI down about 0.7%. Also saw some weakness today earlier on Bitcoin. Let me see if I can get some charts out on that. But even if those charts, there we go. Bitcoin down on the news that Binance getting sued by the SEC in Washington, D.C. civil court. Binance is a big one, guys. Globally, they are the biggest. And so you got to think if Binance tumbles, you're going to see a lot more spillover. But look at this reaction here. This is not an absolute disaster. I'm looking at Bitcoin here. 25,000 is doable. If that's the end of this, fine. But I read the complaint, and there's probably a lot more that's going to come out of it.
Yeah, not an absolute disaster. I wonder if it feels like that's kind of the par we're looking at right now. But Jared Blickery from the floor of the New York Stock Exchange, thanks so much for that.
All right, let's get into more of today's market action, also what we can expect going forward. For that, we want to bring in CapTrust Director of Investments, Christian Ledoux. Christian, it's good to see you here. So we've seen a bit of a pause in the rally that we certainly saw Friday, and really since we've seen since the start of the year, certainly this melt-up type of action that seems like we're looking at in the market with improving investor sentiment. What do you make of the gains that we've seen, and whether or not this momentum that we had seen prior to today, if it can continue?
Good afternoon, Shauna, and thanks for having me. So you know as well as I that this has been a very tech-focused rally, and in retrospect, it makes sense. Tech is where the earnings are most secure. We still don't know just how bad a potential recession will be, if we even have one, and other sectors are much more cyclically tied to that. So I can understand why investors prefer tech. Valuations in the short run generally don't dictate when a run like this will end. And if we have a true end to the rate hike cycle, which could happen here if the Fed decides not to raise again in June, that could be supportive of higher valuations still.
I mean, when you talk about tech, though, so much of the conversation has been focused around AI. We were talking about NVIDIA last week, getting that big boost. You look at a name like Apple today, AI is certainly not sort of the big play for them. I mean, how do you differentiate between some of these big tech names? Because it sounds like in your notes you're saying these are really just incremental gains that we're seeing, but in the broad context of things, AI isn't going to be the single driver, at least within the sector.
Well, no, these are big companies with big businesses, and they're doing various things that investors like. That you talked about in your last segment, the Apple event, that's going to be incremental to their business. Maybe not that much, but still growing the ecosystem. Apple's very good at that. The Microsoft and Googles of the world, they're going to be participants in AI directly, and the impact to their businesses could be actually substantial. And then, of course, there's NVIDIA, who's fueling all this and has to be counted among the big cap tech now. And their impact is huge. And it's probably made your desk that NVIDIA's gotten a little cheaper after its big spike because the earnings growth was even faster than the stock price growth.
Christian, I think the big debate out there is just in terms of the potential that we could see a slowing economy, not only here in the U.S., but really what we're seeing globally. How big of a risk that poses for stocks. What do you think?
Boy, I just don't see the tide directly this time. A recession can take many different forms, and this is going to be very unique in terms of how this plays out. Certainly with unemployment as low as it is, even if we have a move up from here, it's not going to come anywhere close to prior recessions. And if the Fed responds to it, which it's likely going to do at some point with a rate cut sometime within the 12-month period, I would guess, then that'll soften the blow. Stocks like to foresee the end of a negative period. And if this recession, if we want to call it that, or slowdown, ends in 6 to 9 months, then the stocks will react positively in anticipation of coming out of that.
And Chris, you mentioned the potential for a rate cut in the next 12 months. Is that what you're still looking at right now? It feels like expectations have really started to shift.
Yeah, I think it's shifted more into the first quarter of next year for a rate cut. I don't think there's too many that are going to hold that we're not going to get rate cuts at some point. I think that the rate of 5% or maybe a little bit higher than that on the Fed funds rate is actually quite restrictive. And I don't think our economy can handle that for too long. So there's a likely market anticipation. You can see it in the yield curve with the pretty steep decline to the 10-year yield from the 1-year yield. That's anticipating that we need to have lower rates at some point in the future.
All right, Christian, stick around. We're going to get into your stocks to buy and stocks to stay away from on the other side of the break. We are just getting started here on Yahoo Finance Live. Coming up, we'll get expert analysis on Apple's new product launch, the Vision Pro augmented reality headset, plus the SEC filing a lawsuit against Binance and its founder. We're going to dive into the details there. And oil prices rising. We're going to discuss the latest from this weekend's OPEC Plus meeting. Stick around. Much more here on Yahoo Finance on the other side. We'll be right back.
10 consecutive rate hikes, not enough to knock down the job market, yet that number, as you mentioned, continuing to surprise to the upside, blowing out. And that, though, not enough to convince investors that the Fed is going to pull the trigger and hike rates again at the June meeting in less than 2 weeks' time.
This certainly is a good labor market. It's one that's drawing people in, keeping them in the labor force, and providing that access to the economic security that Americans need. A shortage of workers is a mismatch between the demand for workers and the supply available. And one way to fix that is to make sure that employers are offering good jobs.
We really just keep a close eye on our costs and we adjust when we need to. We don't hesitate to do it if we need to. We've been very judicious about it. We're really making sure to just cover our expenses rather than turning our price point into something else.
1, 2, 3, 4, stop the strike and pay us more.
I'm out here because the companies are refusing to treat us like people, essentially is what it comes down to.
At the heart of all of these negotiations is the fact that the writing profession is not financially tenable anymore. Our members have, for example, in television, seen their wages reduced by 24% in the last 10 years and features by 14% in the last 5 years, even though the companies are making hundreds of billions of dollars.
Welcome back to Yahoo Finance Live. Major indices red across the board right now, with the Dow seeing the biggest losses with 45 minutes left in the trading day, down about 156 points. Well, CapTrust Christian Ledoux is back with us to share some stock picks he says are worth eyeing, as well as some that he's trying to avoid. So, Christian, before the break, we were talking about the huge gains that we've seen in tech, AI being a big driver. Let's start with the pick that you like, Alphabet, because they got to a bit of a rocky start when it comes to their AI play. What do you like there?
Well, two parts, really. The first part being the main business, being the advertising model, is starting to show signs of recovery. We had about 12 months in the last 12 months of declines in ad growth, and it seems to have stabilized now and is looking promising in the next 12 months. The other part of it is AI, like you mentioned, and Microsoft made quite a splash with their ChatGPT, and many were suggesting that Google was being left behind. But if you look at Google's most recent developer conference, not as exciting as the Apple conference today, but it was really great to see some of the AI programs that they have in works. And really, they're going to be more the developer tools that are going to be assisting the engineers with AI. And that's where they're really going to make the money. And it's not going to be about the chatbots as much.
Christian, when you take a look into account so many of the thoughts out there just on the street, you mentioned how Google has stacked up to Microsoft in their AI initiatives. Do you think then that maybe Google is closer to Microsoft with its AI play than many are giving it credit for today?
Oh, I'd wager that Google's actually ahead in the technology. They've been doing this for decades. So I would imagine they actually have a technological lead. Now it's about packaging and getting products to market when they didn't anticipate that they would have to get to market so quickly. Microsoft kind of forced their hand, and now that it's out there, I think Google's going to see a nice runway here.
Let's talk about another name that you're liking right now, and that is Jefferies Group. Interesting to note here, this you also tie to an AI play that you think this could generate a lot of capital markets activity, specifically benefiting somebody like Jefferies. Walk me through your case.
Yeah, well, first about Jefferies. So Jefferies is sort of an unloved investment bank. They're living in the shadow of Goldman and Morgan Stanley and Bank of America. But they've come up from the ranks, and they're now the number 5 in the U.S. and growing faster than all their leading peers. But what's really exciting is that when we have a new technology come out like AI is coming out now, what's going to happen real quickly is the venture capitalists are going to sense opportunity for investors in the public markets to want to buy into the trend. And that means they're going to bring a bunch of companies public, and it's going to be companies like Jefferies that benefit from that.
On the flip side, Chris, you have a couple of stocks that you're saying that people should avoid right now. One of those names, American Airlines, and it comes at a time when people, it seems like, are willing to pay whatever they can to get out there and travel. The demand numbers have looked very, very strong. What's the risk that you see?
Well, the strength of travel demand, we've all seen it. We've been to the airports, we've seen everybody full. And that really actually is the beginning of the negative case on this. It's about as good as it's going to get. We've got about as much capacity utilization in the airline industry as we can handle. We've seen the shortages of staff, and companies like American have had to make deals with their unions to lock in higher costs for those elements of their business. And then on top of that is the debt that came from the pandemic period. And that debt is a pretty big burden, especially for American. They have the biggest debt load in the industry. And there's some significant maturities coming in 25 and 26 that they're going to have to refinance at likely higher rates. And by the same time, they're probably going to see a downturn in their main business. So that's going to be a struggle for them.
So the debt's certainly a concern for American, but is it about the debt more than the industry as a whole? Because to your point, you say it's only as good as it gets, but travel really has reached a peak. You see people shelling out a lot of money. You've seen international travel come back. Hopefully business travel comes back. I mean, isn't there more upside, and would you be willing to put your money behind some of these other competitors of American?
I would not. I believe that the industry is going to have a hard time adding capacity in an economic way. What I mean by that is the ability to buy new airplanes, get new gates, get new routes, staff those routes at a time when ticket prices are already starting to soften a little bit. So I would anticipate that we are truly seeing about as good as it gets. And by this time next year, we're going to be seeing negative year-over-year growth rates in almost all the metrics.
Chris, the other name that you have that you're telling people to avoid right now is Lucid. Certainly run into its own set of challenges here over the last several months, selling off just recently last week. Why do you see more downside ahead for Lucid, given the fact that the EV market is certainly starting to heat up?
Yeah, and it is hard to say negative things about a company that has such a fantastic product. If you've seen their car, it's quite exciting. But what's the problem is that these companies are really having a hard time manufacturing profitably. It took Tesla over a decade from the first production unit came off the line to break into free cash flow profitability. And the fact that Lucid and its peers, I would say Lucid is in the same situation as all the other EV pure plays. They are burning cash at a very rapid rate. You saw a couple weeks ago that they raised additional capital, but that capital at the current burn rate is only going to last for about 9 months. They have a little bit more cash than that on their balance sheet, but that's really only going to take them in the 12 to 24 month range of operations. So they're not likely going to get through the burn for the next few years that people are hoping that they do. And they're going to have to raise additional money in a best case scenario, which will dilute investors, or they're going to be facing a bankruptcy, which some of their peers are already facing.
All right, Christian Ledoux, it's good to talk to you today. I appreciate you sticking around.
Thank you very much.
The Securities and Exchange Commission filing charges against Binance and its founder CZ for mishandling customer funds and breaking securities rules. Yahoo Finance's Jennifer Schomburger is following the story for us and has more on that now. Jen.
Good afternoon, Shauna. That's right. The SEC leveling 13 charges against Binance and its co-founder Changpeng Zhao for operating an illegal trading platform and misuse of customer funds, amongst other allegations. SEC Chair Gary Gensler saying in a statement today that the world's largest cryptocurrency exchange, quote, engaged in an extensive web of deception, conflicts of interest, lack of disclosure, and calculated evasion of the law. According to the SEC, Zhao, or CZ as the CEO is known, and Binance understood that they were operating the Binance.com platform in violation of numerous U.S. laws, including federal securities laws. According to the SEC's complaint, Binance's chief compliance officer bluntly admitted to another Binance compliance officer in December of 2018 that, quote, we are operating as an effing unlicensed security exchange in the USA, bro. Among the 13 charges, the SEC alleges Binance failed to register as a national securities exchange, broker-dealer, and clearing agency. The exchange also misled investors by claiming surveillance and controls over trading manipulation without actually having those controls in place. Now, the SEC lawsuit also alleges Binance and CZ misused customers' funds and diverted them to a trading firm that CZ controlled called Sigma Chain. The SEC said Sigma Chain engaged in fraudulent trading that made Binance's volume appear actually larger than it was. Binance responding, looking like it's going to fight this lawsuit, a spokesperson telling me that the company will, quote, vigorously defend its business, calling the SEC's actions, quote, unjustified, and noting that today, despite our efforts at productive engagement, the SEC abandoned and denied us due process and instead unilaterally chose to litigate. We respectfully disagree with the SEC's allegations that Binance operated as an unregistered securities exchange or illegally offered and sold securities. We will see how Binance responds. The SEC has asked to have U.S. assets frozen. Ladies?
All right, Bitcoin off 6% today, heading back towards 25,000. Jennifer Schomburger, good job. Thanks so much. All right, well, coming up, Apple shares pulling back from earlier gains on the 2023 Worldwide Developers Conference. A big headline, failing to impress, it looks like, investors, at least for now. We'll head live to the event when we come back. C3 AI shares have soared this year, up more than 200%, riding the investor excitement around AI, but the company once again the target of short seller Spruce Point Capital Management, the firm recently issuing an open letter to C3 AI director Richard Levin, calling into question C3 AI's business, as well as, quote, unprofessional conduct and treatment toward short sellers from C3 AI CEO Tom Siebel. We want to bring in Ben Axler, Spruce Point Capital Management Chief Investment Officer and founder, along with Yahoo Finance's Ali Garfinkel joining the conversation. Ben, it's great to have you here in studio. Now, we know that you've been going after C3 AI now for quite some time, 16 months, right around 16 months. You've called into question some of their business practices in the past. You've called into question just the fact that they tend to chase trends. What is your biggest issue with the C3 AI today, or biggest concern?
I think there's just been a lot of exaggeration of the claims, whether it's the total addressable market, how much money they've invested in the actual AI technology, the customers of which they've revised multiple times. And again, if they're revising customers, how can we get confidence about the revenue? So it's not just one thing, it's multiple things that add up to what we believe is a highly puffed business with big exaggerated claims.
And Ben, you say that after the company last week beat on both the top and bottom lines. Yes, the guidance didn't meet the street's expectations. Some out there a bit disappointed, but Siebel has said once again that they do expect to be profitable in fiscal year 2024. That's not enough? Or you're not buying it?
Well, I think he's made a lot of promises that have gotten pushed out multiple times in the future. So we want to see not just one quarter of cash flow, but we want to see evidence of multiple sustained cash flow. And we also think that the guidance, which you pointed out, that slightly beat expectations, which were pre-announced, only came in at 10% revenue growth on the low end, 15%. So that to us feels kind of low for AI, which is growing broadly, and not necessarily justifying the 9.5 times, almost 10 times revenue multiple that the market's assigning to the stock.
Hi, it's Ali here. Ben,
Hi.
I want to systematically run through some of these points because, investors are really excited about C3 AI. So I want to be really clear about where your concerns kind of lie. And one of them is, this cash burn problem again. Right. So I'd love to know, a lot of tech companies aren't profitable. Why are you specifically so concerned about cash burn? Is it a product problem? Is it the lack of history? Where does it kind of start and end?
Well, I mean, the company has done nothing but burn through, I think, $150 million, almost $200 million of cash since we first outlined our concerns about the company. They had one, positive cash flow quarter, but, one data point doesn't make a trend. We want to see sustained cash flow, but it's also the dilution, right? I mean, look at the share count. It's continued to balloon. I think, if you look at the operating cash flow and take out the actual, non-cash stock, I mean, there would have been cash flow negative. So this company is highly dependent on issuing its stock to employees. And if the public and employees aren't buying into the value proposition of the stock, then they're going to have to pay, more cash to employees to recruit and retain them. So the company is very fragile and sensitive to keeping its stock valued the way it is.
And I want to kind of, to that end, sort of move on to one of the other concerns you outlined in your report. Yes, I spent my weekend with your report. The CFO revolving door. A lot of companies move through CFOs. Why are you specifically concerned about C3 AI's movement through CFOs over the last 17, 18 months?
Well, I think the facts speak for themselves. I mean, one of the CFOs resigned, I believe, shortly after they came public or right prior, right around the time, which was a little bit unusual. And then they brought in an individual that we pointed out was associated with another company that had a financial restatement and a little bit of a problematic history. He resigned very shortly after our first report. Now they're on to yet another CFO. And so, we do like to see some stability and buy-in from the CFO. And we'll also point out that the current CFO recently sold stock, as did a couple directors after this quote-unquote pre-announcement and statement that they have reviewed our claims and that everything's fine, yet the insiders are continuing to sell. And also, Baker Hughes, their largest strategic investor, also sold recently as well after a hiatus going back to 2021. So, and then a last point I would ultimately raise is they have a buyback program, yet they haven't exercised recently at all to buy back stock, and yet they've made the claims that the stock's undervalued. So, we want to see evidence of stability in the CFO position. We'd love to see a cessation of insider selling, and if they do believe in the future prospects, why not buy back stock?
Ben, are you alleging fraud anywhere within the business, given the fact that the CFO position has been that revolving type door?
No, I'm not making allegations of that. That's beyond my means. But I am certainly making the claim that I believe there's a lot of puffery going on here. I think there's a lot of exaggeration about, again, the TAM, the addressable market, about how much money's been invested, and ultimately about the prospects for the business.
And Ben, I also want to ask, if we're not alleging fraud, then what do you want to see? What is your message to Tom Siebel?
I think the message is get the customer straight, okay? I mean, we've now seen multiple revisions about what they claim to be the customers. Now let's also rewind. 2 weeks ago, they made a statement that they reviewed short seller allegations and that there were no inaccuracies, and they didn't expect anything to come out of it. And then this past quarter, deep within their supplemental, you'll see they added 3 slides discussing how they define customer engagement and also making a customer restatement. So I need to understand, what are the customers? Why do they claim it's very complex to measure a customer? And if I can't get confidence in the customers, I can't get confidence in the revenue.
And you've been sounding the alarm. You've sort of been making this point now for 16 months, but Wall Street doesn't seem to care. So I guess the last thing I'm wondering is, where's the disconnect? Is it just the ticker name that you think people are getting excited about?
Well, I think it is. I mean, there's a lot of retail engagement here, but where have been the large institutional growth technology investors? I fail to see many of them in the share price. I fail to see, stability with the Baker Hughes relationship, and their continued selling obviously is a point of concern. The insider selling, which I already touched upon. So again, I think there's definitely a disconnect about this company, where it can go, and certainly about the valuation. And you don't need to take my word for it. Look at the average consensus target price among the brokers that cover it. You'll get to an average target price of about $25 or $26. So look at where the stock is now, look at what other professionals are telling you it's worth, and then you'll come to the same viewpoint that I have, that the stock's overvalued.
I also want to point out that we did reach out to C3 AI for comment, and they pointed us back to a response that they published back on May 15, saying that their investigations found that none of the allegations or insinuations of wrongdoing made by either Spruce Point or Kerrisdale were supported by the facts. And they went on to say, and no irregularities, misrepresentations, or omissions in the company's prior disclosures were identified. We'll hear from C3 AI CEO Tom Siebel tomorrow. But Ben Axler, Spruce Point Capital Management founder, thanks so much for taking the time to join us here.
Thank you for having me.
And of course, our thanks to Ali Garfinkel as well. All right, coming up, former Vice President Mike Pence is set to run for president. We will check in on the latest from D.C. when we return.
The best way to think about this intelligent data analytics platform that is Toggle is that it sits on a very large mountain of data, and it's constantly giving a number of these assets a daily health check. There's so many things that you could look at as to, do you have fever today? Are you coughing and so on? And same things happen in the market. We would struggle to go through everything every day, read the Fed statement and so on, but computers don't. And so then they can summarize in a few bullet points the three things that you should pay attention to today. ChatGPT is, of course, in the limelight because everybody is now learning how to use this technology. What we have taken is foundationally the same model, but we've trained it specifically and much more narrowly on financial analytics.
Microsoft announced with us last week at their Build conference the idea that a lawyer can go into Microsoft Word and can use a large language model, so an AI model, to auto-generate the first version of a contract, and allows an attorney to, in real time, make the edits and ensure that that draft contract is perfectly accurate and ready for prime time. I think enables a lawyer to do in seconds what previously may have taken hours to do. Our view of this is it will enable lawyers, no matter what their tenure, to get to the fun stuff, to get to the more interesting problem solving, to get to the work that adds value to their clients. And we think that's a really healthy step forward for the profession.
Big banks may soon have to boost their capital requirements in order to buffer potential losses. Larger banks that are heavily dependent on fee income, who may have or have seemed safe from massive regulation, may soon have to keep stores of around 20% under new regulation, which could come into play as soon as next month. This is according to the Wall Street Journal. Well, the reporter from the Journal who broke that story, Andrew Ackerman, joins us now. Andrew, it's good to see you here. So reading through this report, just talk to us just a little bit more about the shift that we're seeing under the Biden administration, how that compares to the Trump administration, exactly what this new requirement would mean for larger banks.
I think it means that they're going to have to raise a ton of capital over a several-year period, and it sort of shows regulators trying to grapple with how do we respond to the failure of Silicon Valley Bank, at least partly. These rules were already in train before SVB failed in March. But the regulators have come back and they said, SVB's failure kind of shows we have to be humble about the risks that are out there, and the overall system needs to be a little bit more resilient. And so they're going to start to impose some of these tougher capital rules on banks all the way down to about 100 billion. So much smaller than the global systemically important banks. You're going to kind of see mid-sized and regional banks of SVB's size hit by these new rules.
So let's talk about what this means for some of these banks. I mean, we've heard some of the big banks already respond in a way to say, look, this is going to hurt the businesses, it's going to hurt the borrowers if those capital requirements are higher. What does it mean for those mid-sized banks that were really at the heart of some of these ripple effects?
I think it means that it's going to encourage greater consolidation. I think that's an open question, but you could see sort of this natural trade-off where banks are sort of, the regulators become more permissive around mergers. So they allow more banking tie-ups in exchange for these tougher rules that are coming over the coming years. That makes sense. You want to be bigger to kind of have bigger economies of scale to deal with the enhanced regulations. But right now, I don't know, that's speculative. The regulatory team in office now has decided that big bank mergers, generally speaking, in normal times, they've been very, very reluctant to approve them. They've been critical of big banks that get even bigger. And so there's this open question, given that we're in this sort of fragile environment, will they be more permissive?
And Andrew, also the consumer impact, which Akiko just briefly mentioned there, but how much harder it could potentially be for Americans to get those loans?
Yeah, I mean, I think if banks are facing a huge increase in regulatory costs, they may very well pull back from some of the activities. I think what's striking about the coming rules and capital rules in particular is that businesses with large fee-based businesses, so wealth management businesses, or American Express, which has a big credit card, they collect swipe fees. They're going to be hit hardest. And so if you're, a Morgan Stanley, where you've gotten out of trading, say, and into something that's relatively benign, like wealth management, do they step back from that? These are all, I think we're going to be following closely what happens with respect to how the banks respond to these new rules.
Andrew, you talked about the potential for more mergers in this space, and I wonder if we can talk about sort of the inherent challenge, some would argue the conflict that's likely to play out as a result of this. I mean, on the one hand, you think back to what happened with JP Morgan when they acquired First Republic and the criticism that came out saying big banks are only going to get bigger. And yet your story seems to point to the fact that the big banks are the ones that are most capitalized, that could, provide most stability to the system.
Yeah, I'm not exactly sure how to respond to that. I think what is worth noting is, the JP Morgans of the world can absorb higher capital requirements. I don't think they have an additional 20% above the current capital rules right now. So I think even for them, this might be challenging. I think it's important to note, the banks are going to have several year phase-in period for most of these changes. It's not just the Basel rules that are coming into play, though. The smaller banks will have what's called TLAC. They'll have to issue longer term debt that for what's called a bail-in if they get into trouble. There's stress tests are going to get much more stressful. So, you're going to see a lot of pressure to consolidate over the coming years. And I think that's an important, thing to watch, how the regulators respond to that.
Yeah, ultimately, I mean, what does that mean in terms of what the landscape looks like in this space, 5 years from now?
Yeah, I mean, I think if you've got, 40 or so banks in the, around 90 billion to, 700 or so, my numbers might be a little off, but you could see that shrinking noticeably, through mergers and tie-ups.
All right, Andrew Ackerman from the Wall Street Journal. Thanks.
Thanks for your time.
Well, it is official. The former Vice President, Mike Pence, is running for president. An FEC filing shows he has signed the paperwork to go up against his former boss, Donald Trump, for the Republican vote. And here to tell us more is Yahoo Finance's Rick Newman. Rick, this is going to be an interesting one. The former vice president and the former president. We know the loyalty that's been baked into former President Trump. Who do you think Mike Pence is going to be able to appeal to?
He appeals to evangelicals, which is why Donald Trump wanted him in the first place. That was the coalition Trump put together. The ticked off white working class plus evangelicals is what helped him get elected. But I don't know how far Pence goes beyond that. And he's going to have a tough time, obviously. He's got name recognition, which a lot of other Republican candidates are not going to have. But he's not Donald Trump. And a lot of the analysis so far says that just as in 2016, the more Republicans jump into the race, the more it benefits Donald Trump because Trump, obviously the biggest name in the Republican Party still, he will get his votes, and then the rest of the candidates will split all the other votes. So it almost looks as if the more the better for Trump, and we're going to get more candidates coming this week and perhaps later this year.
Well, Rick, one candidate that we're not going to get, at least for now it seems like, is JP Morgan CEO Jamie Dimon. He's saying that he doesn't have any intention to run for president this time around. What do you make just of this announcement and the fact that Dimon is officially out of the race?
Smart move. Even though he's prestigious in the business community, I have trouble thinking of an American political party where he could plausibly win the nomination. I think most people think he would run as a Democrat if he were to run. He has associated himself more with the Democratic Party than the Republicans. But guess what? The Elizabeth Warren faction of the Democratic Party loathes Wall. And the idea that, the guy leading the biggest Wall Street bank could just waltz in and somehow get the Democratic nomination, I think is far-fetched, whether he's running against an incumbent such as President Biden or somebody else. He couldn't really make it as a Republican either. And I think Jamie Dimon is smart enough to know this. So he's saving himself some embarrassment, probably along the lines of what Mike Bloomberg faced when he was the well-known businessman, the rational businessman who was going to come in and save the Democrats from themselves in 2020, and he completely face-planted. So Jamie Dimon doesn't want to do that. I think if he wants anything, he wants to be Treasury Secretary someday. We'll see if he gets it.
Rick, what I find interesting about this story is that it wasn't Jamie Dimon on a personal level, but the bank that felt the need to put out the statement to say he's not running because there have been so many voices on Wall Street urging him to run. What do you think that says about what's out there today and how Wall Street views this upcoming race? I mean, especially on the Republican side.
I think the statement by the bank was a statement by Jamie Dimon. I mean, the two are practically synonymous. He's been there so long, and he's the face of the bank, obviously. I mean, let's remember how that started. He did an interview, I think it was with Bloomberg last week, and somebody just asked him, a fairly straightforward question: do you have any interest in ever running for office? And he answered what I think honestly, and he said, yeah, it has crossed my mind. And then Bill Ackman, the hedge fund guy, put out a tweet basically saying, please run, Jamie, please. And that got a lot of attention, so people jumped on it. So I think there was a little bit of momentum among the Wall Street crowd for Jamie Dimon to run, and I think he just wanted to put that all to rest. And also, by the way, reassure everybody with a stake in J.P. Morgan that no, he's not going to leave the bank within the next year to run for president. Excuse me. That's a pretty important thing to clarify, since he's really important to the leadership of that bank.
Yeah, even without Jamie Dimon's name, you look at the Republican field, at least, shaping up to be a pretty crowded field already. Rick Newman, as always, thanks so much.
Bye, guys.
Apple holding its biggest product launch since 2014, with the showpiece being the brand new device, the Apple Vision Pro, a VR and augmented reality headset. Yahoo Finance's Dan Halley is live in Cupertino. Dan, you just stepped out of the event. What did you make of this announcement, as well as a number of other announcements that we got from the tech giant?
Yeah, Shauna, really interesting announcement here from Apple. We'll just go over the big one. That's the Vision Pro. It's the Apple Vision Pro. It's running on what they're calling the Vision OS operating system. It launches later next year for $34.99, so $3,499. It also will run on two different chips, the R1 and the M2 chip. Now, when you look at the front of it, it basically has a display up front that will display your eyes. So Apple basically saying this way you don't feel so isolated from the rest of the world when you're wearing the headset. People who walk up to you can see your eyes and what you're doing. Now, if you're in a more immersive app, if you're in fully VR mode, they didn't mention VR, by the way, at all. But if you're in a fully VR kind of mode, the display will almost kind of look like bluish shimmering lights to just give the person who's near you a sense that, hey, I'm not paying attention to you right now. I'm watching a movie or something along those lines. The big thing here is the display. They say the display has tens of millions of pixels in it. It's one of the most advanced displays that they have to offer. They're using micro LEDs. And essentially what that means is, at least according to Apple, you won't be getting that kind of screen door effect that you would get with other headsets from manufacturers like Meta, as well as HTC. In fact, they say that it'll be essentially seamless. Now, no one's been able to get their hands on one yet. They have them downstairs. This is the Steve Jobs Theater behind me. And they're basically just on display racks at this point. You got to imagine this because it's not quite ready for consumption. One of the important pieces to point out is that it runs on battery power. You can plug it in and run it all day, but when it's on a battery pack, it's only going to run you 2 hours at a time, and the battery pack is separate, so it'll be in your pocket. That's the big announcement for the Vision Pro. There's also, though, a number of announcements from iOS. We're getting new contacts, a new journaling app. The iPad is getting updates with iPad OS, a new health app where they're getting a health app there, as well as customizable lock screen. By the way, with iOS 17, you can use your iPhone 14 Pro as a smart display, and then there's Watch OS updates as well. So a huge slew of announcements. I didn't even get to mention the new MacBooks. There's them behind me, the MacBook Air 15-inch, as well as the new M2 Ultra chip. That's their newest high-end powered chip that's going to be in the Mac Studio, as well as the new Mac Pro desktop. So a huge number of announcements, but clearly the Vision Pro is the biggest here.
Yeah, we saw Intel stock get hit on the back of that announcement of the M2 chip. Dan, I'm going to put you on the spot here because over the years we have talked a lot about VR headsets. and why those just haven't taken off the way that some had predicted. Today, we're talking about mixed reality with Apple. Yes, $3,500 is a high price point, but in your opinion, I mean, is this the one that gets it to the masses once the price starts to come down? I mean, in terms of the use case.
I mean, in terms of the use case, you know, they're adding the kind of Apple layer of software, but it's not very many use cases that are different from what you would do on the Meta Quest, right? It's the same idea. Games, some productivity. Meta's been pushing that heavily. Entertainment, whether that's watching movies, getting in touch with friends and family. So there's no real individual use case here that's different than that. It's really the software that is different. It looks at least more polished from what we saw from a polished presentation. But as far as usage, I can't say how it is yet. I still am kind of not exactly sold on this area of AR and VR becoming a true consumer ecosystem, right? I mean, I think a lot of people are going to balk at that price. Apple recognizes that this is going to be a low-selling product for the time being, and then eventually they'll likely lower the cost of that. But, you know, as far as VR, AR goes overall, this seems to be the one that's going to get people the most interested. What Apple can do, though, is lean on the developers, and that's why they're releasing the ability for developers to go and then create software for this. I think what it comes down to is if people are going to buy apps, it's going to be Apple users. They're definitely the ones that buy more apps or are willing to spend more money compared to Android users. And that could be something that translates into the AR space. Maybe more Apple users will buy apps versus Meta users. And that would get developers to want to start to develop more and more interesting apps for the hardware. I think really the fact that Apple has something that they've put out is going to get developers a lot more energized, and maybe then we'll start to see the use case. But it's worth pointing out that the Apple Watch very much launched at a time where people were saying, well, it really doesn't appeal to me. It went on to become the best-selling smartwatch out there because Apple eventually honed the message of that to health. So I think that's what we might end up seeing here with the headset as well.
Yeah, the first major product launch in roughly a decade. So we'll see how that goes. Dan Halley, great work out there in the field. Thanks so much for that. Well, coming up, we're going to get you set up for the closing bell and check in on some of the top trending stories of the day.
And that was a closing bell on Wall Street. Again, all three of the major averages ending the trading day in the red. You can see some of the losses Extending to the downside here in the final 60 minutes, the Dow closing off just around 200 points. S&P briefly touched the highest level that we've seen in 9 months, but ended the day in the red, off just about 0.2%. The Nasdaq also lower on the day. Take a look at some of the bigger movers. And first up, we got to talk about oil prices closing the day higher after Saudi Arabia said that it is going to slash oil production by 1 million barrels a day starting in July. The move is expected to help stabilize the oil market with prices tumbling last month on demand concerns. It did close higher, but not by much. And Akiko, I think this maybe caught some people by surprise, given the fact that we didn't see more of an upside reaction.
Yeah, I mean, when you think about the last cut that they had in the spring, it was sort of similar. We did see it move to the upside. Obviously, OPEC Plus wants to get it to above $80 a barrel. It did breach that level, but then it came back down. And that seems to point to what we're seeing looking ahead in terms of what the outlook is. It's about weak demand in the U.S. and Europe, but also the fact that the Chinese economy hasn't picked up as quickly as many had expected. That's where a lot of that demand could come from. So interesting to see the Saudis leading on that as well. Probably points to where the economic outlook is right now. All right, shares of Ford Motor closing the day in the green following an upgrade to buy from neutral from an analyst over at Citi, citing positive demand trends and improved risk reward for the auto giant. Ford sales grew nearly 11% year over year for the month of May. When you talk about a company like Ford, it is really about the two tracks that they continue to push on, the gas-powered vehicles, but also the EV pivot that still is losing money, but really trying to gain market share on.
It certainly is still losing money, but we have seen some excitement around Ford's initiatives, its venture into EV. The products that they have available today, the F-150 Lightning, has been a very positive reaction from many of those customers, some really questioning whether or not the pickup driver would be willing to move to an electric vehicle. It looks like, at least from these early demand numbers, that it is trending in the right direction. They also had that recent partnership with Tesla for their charging network. That is seen as a positive here for both companies. But Ford does have this momentum moving in the right direction for the company. I think the big question, though, is who is going to be that big competitor to Tesla and whether or not Ford has enough in order to get there, and the fact that the vehicles still cost so much.
And the trucks are really the key, right? You talk about the F-150 Lightning, and I keep going back to comments that we heard from Jim Farley very early on when they were getting the reservations in, but how surprised he was about the new drivers that were coming in. It wasn't about the usual drivers who already own the gas-powered trucks, but also those who are looking at EVs. So that's another thing to consider, I think, is, we tend to think, oh, you just switch over from the gas-powered vehicle to the EVs, but others who are saying, look, now that I know it's a little cleaner, maybe I'm willing to get into the F-150 Lightning as well. Shares of Apple closing lower, well off earlier highs after the announcement of the Vision Pro headset, but there were plenty of other movers as well, tied to the World Developers Conference. That includes Intel, Disney, and a name you may not know, Unity Software. That stock popping after Apple said it's working with the company on the headset. And you look specifically at Unity stock on track for its second largest daily gain since debuting in 2020. I mean, as Dan said, this is still a huge, huge test, but you get developers, a software company like Unity on board. Their gaming still is the very first application with technology like this. And if they can get third-party developers in there really churning out the content, that could mean huge upside.
Yeah, that could certainly be the differentiating factor. Clearly, great news here for Unity. You can see that reflected in the stock price today. I think there's lots of questions just about how big of a hit this headset is going to be. Personally, it exceeded my expectations. I was pretty negative on this device going into the event today. They made it much more applicable to everyday usage than I was thinking a headset would be, just in terms of what it could do for sports viewing. It could take you essentially courtside to an NBA game, what it could do for entertainment for some of the movies. We saw Bob Iger up on the stage talking about the partnership between Apple and Disney and the fact that Disney Plus is going to be available on this device day one when it does launch. So I think they did do a great job of laying out the use case, but whether or not this is the device that so many have been hesitant from, at least when you take into account some of the VR devices out there, if this is going to be it, probably not given that price tag, but if it sort of paves the way to that Main Street adoption.
I mean, one more thing to note here, because we're talking about other stocks that were getting hit. Intel getting hit on the back of the announcement for the M2 chip. Worth noting, this is for the Mac Pros, 3 times faster than the old model under Intel. Remember when they split with Intel, there were questions about, how Apple was going to proceed, and this is just another step in moving in that direction.
Yeah, Intel shares closing off just around 4.5%. All right, well, after years in the making, Apple revealing its brand new product for the first time, the huge product launch here in just about a decade, since 2014. The Vision Pro is the first of its kind from the tech giant, rivaling Meta and some of the others that are already dominating this market. But could this be the headset that really is a game changer for VR? Joining us now, we want to bring in Eric Abruzese, and we also want to bring in, he's a research director at ABI, and Bob O'Donnell, the research president and chief analyst here at Technalysis. Great to have you both. Eric, let me start with you since you were at the event. What did you make of this headset starting there, and whether or not this is going to be a game changer for this sector of devices?
Well, it's a great question, Shauna. I mean, it's clearly a very exciting device. And like you said, I think they did a good job of positioning it in a way that a lot of different people could see, oh, maybe I could use that. That is, of course, until the price point hit. And then that's obviously a big concern. But here's my bigger concern, because I've tracked and watched a lot of these AR and VR devices over the years. And Apple did a fantastic job of showing this vision. But we've seen some of these things before with HoloLens and with Magic Leap and with the early Meta stuff. And the question really for me is, what's the long-term wearability of the device? Because what I've found in the past, and I even did some research on this before, after about 30 or 40 minutes, a lot of people are like, this is uncomfortable and I don't really want to wear it. Of course, the battery pack only lasts 2 hours anyway. But that'll be a big question, is what's the long-term comfort? And then does it deliver enough value for that $3,500 price point?
Yeah, Bob, it feels like comfort's really going to be key. I mean, I'm with you. I've tried on these headsets before. You get a bit of a headache after a while. But, my question to you is about the timing of all this, because there was so much anticipation around this. You could argue last year was the year of the metaverse, where everybody was talking about these headsets. Apple had to delay things a bit. Now it feels like the enthusiasm has kind of died down. Can Apple in the launch today reinvigorate that?
It's a great question, Akiko. And, I think they're clearly going to. It's Apple, right? I mean, Apple creates categories. That's what they do. And they're famous for that. And I think you're going to see reinvigoration. The other big question I have in terms of, besides wearability, is the experience. There's no controllers. It's only going to be your hands and your voice. And oh, by the way, the voice is Siri. And it's not a generative AI-powered Siri. It's just plain old Siri. So let's see what happens there, because if that experience isn't great, then I think that could be a challenge as well.
So, Eric, I know you're paying close attention to the price and the target users. Enough to make this product successful?
Well, like Bob said, they did everything right that they could have. If you do everything right, it has a cost in an early market like this with nascent technology, and we saw that cost. They had a fine line to tread between consumer and enterprise content, and I think they did a good job. They announced enterprise partnerships and they announced consumer partnerships with Disney. So they've covered all their bases. $3,500 is a tough pill to swallow for anybody. It creates a difficult go-to-market, I think, if you're going up against similar headsets like Meta Quest Pro at $1,100 or Quest 2 and 3 that are $500 and under. Does it deliver 3 times or 5 times or 10 times the value of those? That's up for debate. I think a lot of people will probably think no, but Apple is very good at delivering unique content in a very seamless way. And so I think the use cases and the user experience will probably be best in class. And it really leads to a future product. I noticed that Pro was already in the name. Usually there's a regular device and then a Pro. So, I expect a regular non-Pro device going forward that'll be a lower cost.
Yeah, I mean, and that's the next step, as we've seen Apple do that with past product launches. To what extent, Eric, do you think enterprise is going to be the driver of all of this? Because, yes, you're always going to have Apple enthusiasts who are willing to shell out the money, but not everybody can afford $3,500.
Right. And $3,500 is enough where not a lot of enterprises are going to afford it either. So it's a really challenging price point. But even still, it's 100% going to be enterprises driving it first. There's some developer backend support that I liked hearing about. It is Worldwide Developers Conference, so that was as expected. And that early developer ecosystem combined with some enterprise trials, it won't ship 20 million units in enterprise, but it'll certainly ship some units. There was tons of hype and anticipation at Augmented World Expo. I had the pleasure of being at last week. So there's definitely interest. I think even that interest will maintain even at $3,500. It just needs hampered expectations around how many shipments will actually go through.
Bob, with Apple aiming at AR, is that going to help Meta really maintain the leadership role it does have right now when it comes to the VR headsets? Maybe it won't be as big of a competitor as we thought this product could potentially be?
Well, potentially, but here's the thing, Sean. I mean, VR has always been more of a niche audience, and it's great for gaming and things like that, and it allows you to certainly get to a lower price point. But even Meta, we've seen, has been moving towards more mixed reality, where you have the see-through lens to be able to, perceive the world. So it's going to be interesting to see. At some point, I mean, I imagine we're going to have very, very low-cost VR-only headsets. In fact, we've seen some of those from some of the Chinese manufacturers in the past, but they've always been a bit of a niche and kind of a throwaway item. At these price points, whether it's the MetaQuest Pro or obviously the Vision Pro here, I think the expectations are going to be a lot higher for that more augmented reality experience. And like Eric said, look, there's going to be a Vision, an Apple Vision at some point that hopefully is at a much more attractive price point that has a lot of these capabilities. But we got to see what the apps are like. We've got to see what the experience is like as well.
Bob, we like to talk about the chip makers. And, I'm going back to several years when Apple parted ways with Intel. The question was, what's going to be, Apple's sort of core in terms of what they're developing. The M2 chip announced today for the Mac Pro. You talk about high price tag. The Mac Pro's $6,999, $7,000. I mean, what does this tell you about Apple's internal ability, the research, the tech they have to really churn out these products that they can own the stack on?
Yeah, sure. I mean, look, let's not forget the Mac Pro is a workstation. Apple doesn't call it that because that's not an Apple-y word. But if you compared it to any other Intel-based system, it would be a workstation. And there are Intel workstations that cost in that range. And also remember that the Mac Pro is using an Intel chip from many, many years ago. So it's not a surprise that the performance on the M2 Ultras was much better. It needed to be. But Apple's got these niches. Mac Pro, again, that sells in the, barely nudging in terms of the units compared to the rest of the Macs. The Studio is a more interesting line where they've got this M2 Ultra. But to your point, what we've seen Apple do, and we saw this again here with the Vision Pro, they're developing their own silicon, their own chips, and all the components they need. In the case of the Vision Pro, they took an M2 that they already had, but they added this R1 chip for the sensors. And that makes a big difference in terms of, when you move your heads around and all the sensor data, not giving you a sense of vertigo or other sickness, which a lot of these headsets do. Still haven't had a chance to try it yet, so I don't know. But of course, that's going to be the big question, is what they can do. But their overall vision clearly is to verticalize as much as they can, and doing all the silicon on their own allows them to then charge whatever they feel they can get away with.
Well, Bob, when you get your hands on the Vision Pro, we're going to have you back on this show. Bob O'Donnell and Eric Abrazazi, it's good to have both of you on today to break down all of the launches from the Worldwide Developers Conference. Well, coming up, we're going to switch gears and look at the state of electric vehicle infrastructure, especially in the wake of that announcement from Tesla and Ford last week. The CEO and president of ChargePoint is going to be joining us next.
The best way to think about this intelligent data analytics platform that is Toggle is that it sits on a very large mountain of data, and it's constantly giving a number of these assets a daily health check. There's so many things that you could look at as to, do you have fever today? Are you coughing and so on? And same things happen in the market. We would struggle to go through everything every day, read the Fed statement and so on, but computers don't. And so then they can summarize in a few bullet points the three things that you should pay attention to today. ChatGPT is, of course, in the limelight because everybody is now learning how to use this technology. What we have taken is foundationally the same model, but we've trained it specifically and much more narrowly on financial analytics.
Microsoft announced with us last week at their Build conference the idea that a lawyer can go into Microsoft Word and can use a large language model, so an AI model, to auto-generate the first version of a contract, and allows an attorney to, in real time, make the edits and ensure that that draft contract is perfectly accurate and ready for prime time. I think enables a lawyer to do in seconds what previously may have taken hours to do. Our view of this is it will enable lawyers, no matter what their tenure, to get to the fun stuff, to get to the more interesting problem solving, to get to the work that adds value to their clients. And we think that's a really healthy step forward for the profession.
Well, ChargePoint shareholders have been on a wild ride in the last couple of weeks, from an earnings sell-off to a big gain on an upgrade. Joining us now is Pasquale Romano, ChargePoint CEO, President, and our very own Praz Subramanian. It's good to talk to you today. It feels like last week, a bit of whiplash when you think about the upgrade that ChargePoint got from Bank of America, and then the sell-off that we saw in the stock on the back of what the street saw as a disappointing sales outlook. Talk to me about what the demand picture looks like for you right now, especially as we've seen gas prices come in lower and maybe the enthusiasm for EVs slow down just a bit.
So I think what we have is a phenomenon in the EV industry where the overall auto sector may be a bit soft, but EVs are a growing percentage of new car sales, and that's offsetting it substantially. And just to give you some a data point, our Q1 revenue results that we announced, those were a 59% growth measured relative to Q1 of last year. So even in what is a choppy macro with respect to the overall economy, you've got a tremendous amount of growth. We are bolted right up against EV penetration because it's what drives demand for our products. So we're effectively an indicator of where EVs are going and what kind of demand they're driving across the charging sector.
Hey, Pasquale, it's Pras here. So looking at the kind of ChargePoint outlook, you guys are hopefully going to grow more, add more availability, add more chargers. Is that sort of going to address sort of customer complaints about reliability and things like that when it comes to locations?
Yeah, so to remind you of, and all the folks out there of our business model, we don't actually own the chargers. We effectively sell them to businesses, and then they pay us a subscription fee to keep it on the ChargePoint network. But what we also offer all of those customers is our Assure program. And that is our parts and labor, we take care of it so you don't have to worry about it. Charging program to make sure effectively that the chargers are in good working condition. We also take care of making sure drivers understand what chargers are up and running and which aren't via our mobile application. And we're going to continue to innovate and push the boundaries there to make what is a truly mission critical infrastructure for drivers just seamless and transparent. So lots of effort historically on the company and lots more effort on a go forward basis on that subject.
One of the big announcements we got in this space most recently, Ford and Tesla announcing that partnership that allows Ford drivers to use the Tesla infrastructure as well. How does that, or does it, take any market share away from ChargePoint? Do you see that as a direct threat to sort of the gains that you've made in the market so far?
No, we don't see it as a threat at all. In fact, if you look at what Tesla's represent on a market share basis in the install base of vehicles out there. They're driving the overwhelming utilization of even ChargePoint chargers out there because it's just an adapter that allows any car to be used with any station. There are effectively two connector types out there in the United States, the one that Tesla developed long before there was a standard, and then the standard that is that emerged that the overwhelming majority of the auto industry uses. And Teslas have been using via adapters our chargers since the beginning of revenue at ChargePoint, and frankly represent, again, the lion's share market share out there on a go-forward basis. We'll innovate technologically to make sure that it's easy for all drivers to use ChargePoint stations. So we don't see it as anything meaningfully different because we have effectively, as I said, coexisted with that ChargePoint, with that supercharger network since the beginning of revenue at ChargePoint.
Hey, Pasquale, just to clarify, so are you saying that ChargePoint will have native NACS plugs at the locations, or people will continue to use the adapters for Tesla users with your chargers? So
we have fully modular cables on our fast chargers. In fact, our newest products, changing a cable type and a holster on the product is actually quite simple, and we've done that to leave the flexibility. Now, stay tuned because we're looking to innovate here. We don't want our customers to have to assign our business customers to have to assign a particular parking space to a connector type, because you'll never get that mix right, and that mix will change over time. You want to make sure that any car can park in any parking space and use the charger, because that's just what's simple for consumers. And that's just what consumers want. So we're looking to innovate there to make sure that we can adequately support both standards and potentially even go beyond the consumer having to carry that adapter in their car. Although those adapters are widely available, I happen to have one in my Tesla. And so it's something that I think consumers are used to right now. We'd like to do a little better.
I want to follow up on the point that Pras made earlier about the reliability issue. I mean, ChargePoint, I will say just from personal experience, most of the time they're working, but I'm constantly amazed at how few chargers that are out there are working. And I wonder why you think that is. I mean, we're sort of in this space where we've got EVs that now make up about, 5% or higher in terms of market share of the overall car market. And yet the infrastructure itself seems to be the biggest headwind to getting more adoption.
Yeah, it's hard for me to speak for other manufacturers, but what I can say that we do is we take reliability very seriously. We've got a massive investment in a long-term reliability test lab. We put all our existing field products, as well as anything new or any changes we'll make to existing products in the field. We put them through a very, very torturous set of tests to make sure that they don't break in the first place. With that said, you're always going to get some amount of field breakage. It's impossible to have zero breakage in infrastructure that's out there that could be effectively backed into by a car or what have you. So for us, it's now all about detection of that as rapidly as possible. Remember, all our chargers are connected to our back office, so we see them all as to whether they're healthy or not. We've improved our on-charger diagnostics and sensors to really look and enable very proactive monitoring of chargers that are out there. And with that said, there are some things that our electronics can't see, and we rely on our drivers and some future innovation that we haven't announced yet to really report as rapidly as possible to us when there's an issue, so we can then take care of it as quickly as possible.
Okay, well, we hope to have you back on the show when you're ready to make that announcement. Pasquale Romano from ChargePoint, it's good to talk to you today, and our thanks to Pras as well.
Thank you very much.
Well, coming up, we go around the horn and check in on some of the top stories of the day. Stay tuned.
Let's take a look at some of the top trending stories. Yahoo Finance's Alexandra Canal, Josh Schaefer joining us here at the table. First up, let's talk about Twitter. U.S. advertising revenue down 59% in the month of April from a year ago, according to a report out here from the New York Times today. The company forecasting that its U.S. ad revenue this month will be down at least 56%. A new CEO taking over the job. Akiko, she has a tough challenge ahead of her in order to try to get back some of that lost revenue.
Yeah, like on the one hand, it's not surprising that it's been down when you consider just the bumpy ride it's been since Elon Musk, but it's surprising because it's now a private company. We don't usually get these numbers. An important reminder, 90% of Twitter's revenue came from ads before that, and that's a huge problem. Linda Yaccarino now stepping into huge challenges. Advertisers don't want to put their money behind content that is controversial, which Twitter has been.
And it just gets back to, too, it's hard to recreate and reinvigorate growth when you're talking about Twitter right now, when you think about just rebuilding in this environment, right? People are spending less on ads in general. I think that's important to highlight here, too. People are spending less on ads overall, so then if I'm a company and I can spend on Instagram or TikTok, one of the more popular social medias where people are having more sales success, I'm going to spend there, and then I just don't have money to go to Twitter, right? And I think Twitter's dealing with that to some respect too, where their ad budgets are overall shrinking right now. And so why would I spend money on Twitter when I can spend money on a social media platform that quite simply more people are on?
Yeah, and to that point, it's not just tech giants dealing with this. We also have media companies like Warner Brothers Discovery and Paramount. We're seeing that in their earnings reports. Spotify, an audio company that we're going to talk about in just a bit, also dealing with this ad slowdown. And there was a rise of reported hate speech on Twitter that spooking some advertisers, but you have to think of other ways that Twitter could potentially monetize ads. We've been talking about Twitter Spaces, how that could be a lucrative opportunity for advertisers, especially since they've had some notable names on the platform recently, like Ron DeSantis, Ford CEO Jim Farley, just to name a few. So those could be moments where advertisers can say, look, that could be a good opportunity.
Or some kind of shopping aspect, right? I feel like all the other social media apps I use now prompt me to shop within the app, like Instagram, Facebook, and you get sort of benefits from shopping within the app. Twitter never does that for me, so what am I getting out of the ad?
And when you think about it, one of the first things that Elon Musk talked about was charging for that blue check mark. That hasn't really worked out well. That was supposed to be one of the big revenue drivers, or at least one of the levers.
Well, I was going to say, and also just the fact that he did remove that blue check mark. A lot of people don't use Twitter like they did a year ago, 2 years ago. So you don't have that trust there. You don't have people as reliant on Twitter for news, given the fact that so many people are not paying for that check mark. Yes, some people have still been given that check mark and they're not paying for it individually. But I think a lot of people are kind of second guessing the information that they get on Twitter even more than they were before. And that's going to hurt advertisers' willingness to spend as well.
Well, in case in point, we saw that image, right? The AI generated image of a supposed attack that wasn't in the Pentagon that had a blue check mark. So that points to some of the challenges Twitter has. All right, next up, we've got Spotify planning to lay off 2% of its workforce, specifically from podcasts. And, Ali, I'm curious to get your take on this because I was looking through the numbers here. Since 2020, Spotify has spent $526 million on podcasts. This was a huge bet. So the fact that they are laying off a portion of that workforce, are they back to where they were before, or is this about something a little bigger where we keep hearing that, podcasts, yes, they're still popular, but the momentum that we saw over the last few years isn't necessarily there?
I think Spotify is still betting on podcasts. They're just changing up their strategy a little bit. They're not going to focus on every single podcast out there. They're going to be a little more strategic. And we've heard Daniel Ek, who's the CEO of Spotify, really stress efficiency. And Spotify has said that 2022 is a peak investment year. And starting in 2023 and heading into 2024, they really want to optimize and they really want to operate efficiently. And unfortunately, that does include layoffs and that does include pulling back on spending. Over the past 4 years, Spotify has spent more than $1 billion on podcasts. There was a reported $200 million deal with Joe Rogan. Kim Kardashian, she ain't cheap. She was signed on to the platform as well. So you can't have these big names and throw out all this money and expect not to have to make cuts down the line.
Yeah, and I was going to say, just in terms of the relationships that they do still have with some of these A-listers, they're still paying top dollar. I wonder if we're going to see more and more of a pullback here from Spotify as those initial deals do expire, if they aren't getting that return on investment. But you got to question, I guess, just in terms of how they find that balance, right? How they do still maintain that edge when it does come to podcasts, relevant, have the star power that they need in order to get the listeners, while also saving and making sure that the business is very efficient.
It just seems like you can take a top-down approach to some extent, right? You can still pay Rogan close to $200 million if you have to, because who has the most listened to podcast in the world? Joe Rogan.
Yeah.
And then you pay Alex Cooper for Call Her Daddy and some of those really, really popular podcasts that they have, and maybe you just don't need the quote-unquote podcast network that we were talking about a couple years ago, right? Where you have a million different podcasts. Then you just need a few.
I go back to your point, though, because I think it's interesting about how, is it going to just be about the big names? Because when you think about podcasts, the discoverability has been, at least for me, is what's made it so attractive. You already know what Joe Rogan's going to say, Kim Kardashian, but it's the other ones that have come on board. Obviously, they don't cost as much, but sometimes they cost a little more to produce. And maybe, Spotify says that's not really where we want to put our bets anymore.
And it was just reported late last week that Jamil Hill, she's exiting her Spotify contract at the end of the summer, and she's been on the platform since 2019. So that's, something that I think we're going to see more and more of, like to your point, just more of these bigger names exiting Spotify, seeking other types of platforms, but it does hinder the overall consumer experience. So something to keep an eye on. And moving on from layoffs to an ongoing writer strike in Hollywood, entering its 6th week, we did get some positive news out of Hollywood with the Directors Guild of America striking a tentative deal with studios. This deal includes gains in wages and benefits, a 76% increase in foreign streaming residuals, which is a type of royalty payment, along with a, quote, groundbreaking agreement in regards to AI. And we do know that artificial intelligence has been more of a near-term threat for a lot of these jobs in the creative industries. However, what I've been hearing, what I've been reading, it's not going to really move the needle in terms of those ongoing negotiations with the WGA. We have SAG-AFTRA, that's the union that represents actors. Their negotiations start this week. It seems like it's every man for himself a little bit, and the WGA is really sticking to their guns that right now they are looking for a very specific deal. And just because the DGA was able to strike one, it doesn't mean that that's going to fly with them.
Yeah, which makes the SAG-AFTRA discussions even more interesting, right? Because that has always been seen as sort of the first thing that studios want to. They want to discuss the DGA first, reach a deal. They've got that deal. They want to do SAG-AFTRA, then go back to the WGA. If SAG-AFTRA those discussions hit a snag, then what happens? That could mean a more prolonged strike, at least on the writer's side.
And that's essentially what we saw in the last writer's strike, right? They struck that deal with the DGA, and then the WGA came later. But that is something that the Writers Guild is saying they don't want to happen again. They have very certain terms, and they want to make sure that the studios aren't cherry picking just because they have this current deal on the table with the directors.
And obviously this is having a massive impact on so many of the media giants out there. But I know, Akiko, you were out last week talking to some smaller business owners just exactly about the ripple effects that a strike like this has on the economy, and certainly affecting a number of businesses that maybe you wouldn't think about. You read about local dry cleaners to restaurants, things like of that nature that are feeling the impact of so many people, of so many writers still being on strike.
Yeah, I mean, real estate, another one. We were talking about this earlier. Realtors who are just saying, look, there's a lot of writers in this town that get paid well. The longer they go without working, maybe that starts to take a hit too. The interesting thing for me, though, is that in all the conversations you have with writers, how are you going to let your finances, how are you going to meet your finances longer this goes on? They all say, look, this is kind of how the structure already worked. You go with 10 episodes and then you don't work for 6 months. Sometimes you don't work for a year. And so they are prepared to be in it for the long haul because of how the structure already is. And, you have to wonder how it hits
My
the
biggest
economy.
question about this, and Allie, I'm sure you're tracking this part of it. How long does this need to go on until we start missing shows? For me, I remember Friday Night Lights got ruined by the last writer's strike.
I remember Grey's Anatomy.
That's my main memory of the last writer's strike from a consumer standpoint. I'm wondering how long this goes until we start missing some episodes.
Well, it's already starting to happen to a certain degree, right? Just in terms of the delays that they are.
Right. But when do we see that on the streaming side, I guess, is my question. Because those shows.
How long is that pipeline and when does it really
Is it
dry
October comes and then all of a sudden there's no new TV? I don't know. I'm curious.
I know, and I'm watching Ted Lasso. I just finished up the 3rd season. That was heavily delayed due to COVID and due to other things. So I also feel the consumer has just gotten used to a delay in our favorite shows. And I know I always need to go back and rewatch recaps just to understand what happened.
Because you go like 2 years.
It's always 2 years now anyway.
It's always 2 years. And I think that is a big question, is how is this going to impact the consumer, their favorite shows? All these streaming platforms have said, look, right now we have enough content banked. But I think if we see this continue throughout the summer into the fall, we got a problem.
Yeah, I was gonna say, I always leave way too much time. Even if the show does come out, I just started the second season of Bridgerton. That season has been out for some time. I was watching with my husband last night, and we're like, what happened? Neither of us had any idea. So we had to go back.
Recap, the recap business. I haven't finished Succession yet, and I've stayed away, so no spoilers.
Yeah, another one. I haven't started that latest season yet either. All right, Allie and Josh, thanks so much. Well, coming up, Royal Caribbean CEO Jason Liberty joining Yahoo Finance to chat the state of travel. Stay tuned.
Well, the strength in travel demand is providing cruise liners with some wind in its sails as Royal Caribbean looks to continue the travel optimism into the summer season. Yahoo Finance's Diane King Hall sat down with Royal Caribbean CEO Jason Liberty on the state of consumer demand and the type of customer the cruise line is servicing now. Take a listen.
We saw incredible acceleration here in the first quarter in the demand environment, which caused outperformance in our first quarter, and we raised our guidance for the year, our earnings guidance for the year, by over 40%. Those trends continue to be very strong, and we get to deliver 150,000 vacations every single day to our guests, and they're super happy.
What about 2024 and beyond? Is it still smooth sailing?
Yeah, well, really, for the past couple months, and certainly right now, most of the bookings we're taking on is for 2024. So the demand trends that we've seen earlier in the year is very much flowing into 2024 and even into 2025.
And what are your expectations for EBITDA through 2025? We know you have the trifecta program where you're trying to hit 3 benchmarks. Where do you stand with that?
Yeah, so we're very much on track for our trifecta goals. One is to get to triple-digit EBITDA per APCD. Second one is to be well into the teens on an ROIC basis, and then getting our earnings up into the double-digit zone. Again, as we burn off a lot of this negative carry that we had to take in during the pandemic. So we feel really good about the cash flow generation of the business, and we feel we're very aligned with our trifecta goals.
And let's talk about the customer, the type of customer you have now. There were people during the pandemic who said they would never return to cruise. Are you seeing a return of loyalists, previous customers, or are your customers now new to cruise?
Yeah. So historically, pre-pandemic, about a third of our guests were new to cruise, a third of our guests were loyalists, and a third of our guests were first to brand. What we see now is propensity to cruise has completely returned back to where it was in 2019. But we're seeing more new to cruise than we had seen in 2019. We're seeing more first to brand, which is very much in line with our growth expectations for our capacity growth as our new ships come on.
And what about the demographics? Cruise tend to attract more of middle-aged customers, and of course you have families. What are the demographics like now, and what are you doing to attract younger customers?
Yeah. So we have really 3 core brands that are really in their different segments, and so they all address different age and demographic categories. Like our Royal brand is very focused on multi-generational family. Our Celebrity brand, people that are in their early 50s, more Gen X in nature, and then our Silver Sea brand, which is ultra luxury and expedition, tend to attract a little bit of the baby boomer side of things. What we are seeing is the guest is actually a little bit younger on average than what we saw pre-pandemic, and a lot of that is because there's more millennials that are now into the system as they got married and started to have kids and are looking to experience incredible travel experiences.
That's
like
awesome.
us.
All right, and talk to me about pricing. How is that holding up in the face of consumers starting to make cutbacks in different areas of their life? We're hearing that from different industries, different companies. What are you seeing, and how are you dealing with that from a pricing basis?
Yeah, so we've actually seen, and we continue to see, the ability to raise price in the current market, which is somewhat counterintuitive to the point you just made, and also counterintuitive to some of the information that's out there. The main driver of that, one, I think, is having best brands, best ships win, and our guests get this incredible experience on our ships, and that gets broadcasted through advocacy of our guests who are experiencing that. But there's also a pretty significant value gap to land-based vacation. And so as RevPAR and other things went up on the hotels and land-based vacations, we have that opportunity now to begin to close that gap. And that gap was about 15-20% pre-pandemic. Today it's about 35 to 45%. And we're going to make a pretty good dent in it here in 2023.
Is revenge travel still a thing?
I think it's less about revenge travel. We don't really see, in our surveying of our guests, it's more that the guest has shifted back to this trajectory of experiences outpacing buying stuff. And that's what we're seeing from our guests, and what we collect in our survey data is they've bought enough stuff. What they want to do is collect experiences, create stories with their friends and family and loved ones. And fortunately, that's what we do for a living.
Okay, and I got to ask you about tipping. Tipping is a big part of cruise life. Your waiter, your steward, your purser. But there's been kind of this backlash about tipflation. How do you keep customers and staff happy given that kind of climate?
Yeah, so we're not in a place where we're charging for a kitchen fee or those type of things. We have a gratuity. It raises typically just based off of how inflation is changing, and that's more what it is. It's pretty much a standard fee. Of course, our guests can provide more. The guests can also choose not to tip if they don't choose to. But a gratuity-based system, a service-based system, we think is really important. But we're not chopping at every corner here on tipping. We have pretty much a standard fee for it.
And one more question for you. What's the China story like for you now as demand come back?
Yeah, so we're now that we now have a better view on how China's going to start back up. Our plan is to re-enter China next year. So we're starting up that sales and marketing machine for China, which was an incredible market for us pre-pandemic. We know that the Chinese consumer loves to cruise. They love our brand, the Royal Caribbean brand, in that marketplace, and we expect to be there next year.
All right, well, sticking with travel, earlier today, Yahoo Finance spoke with Marriott International CEO Anthony Capuano on his expectations for the summer travel season. Let's listen.
I think our Q1 results really underscored that resilience. Q1 was the strongest quarterly EBITDA the company's ever experienced, and Q1 normally is a bit of a quiet quarter. We saw strong recovery across price tiers and across geographies, and that continues. I was just looking at some July 4th data. RevPAR, which is obviously revenue per available room, the metric we use to track performance, is up about 10% year over year. Forward group bookings through the end of the year look particularly strong, and that's what caused us during that first quarter earnings call to actually raise global RevPAR guidance to 10 to 13%.
You talk to a lot of people, a lot of global leaders, Anthony. What do you think is driving that? Because what I think a lot of investors hear, the economy is slowing, maybe not doing as well as you would expect in this cycle, but that's not what we're hearing from your company and a lot of other hotel chains.
I'd say two things. Number one, even prior to the pandemic, you saw a bit of this shift away from consumers spending on hard goods and moving those dollars towards experiences. It certainly appears when we look at the data that the pandemic acted as an accelerant to that trend. And maybe pre-pandemic, that trend was more limited towards younger consumers. It appears to be across demographics now. And then I would say, secondly, the consumer remains strong. You saw the jobs report last week. And of course, there are sectors like tech where you've seen some job losses. But in general, unemployment is low. Consumers are feeling a bit more confident, and that's driving travel demand.
Is your business in the U.S. back above pre-pandemic levels?
It is.
Wow. In terms of all brands, or there are certain brands in your portfolio? What, 31 brands?
31 brands, yeah.
What's driving it?
It's less about the brands and maybe more a little market specific. So leisure destinations are well above where we were pre-pandemic. Urban markets that have some leisure element, New York's a great example of that, well beyond. There are some markets, San Francisco comes to mind, that are still working their way back. But most geographies are back. Even mainland China is back above where we were pre-pandemic, despite the fact that international airlift is only about 40% of what it was prior to the pandemic.
And what are you seeing in terms of business travel?
Business travel is kind of the tortoise in the tortoise and hare, slow and steady recovery, but you almost have to look at it in two categories. Small and medium-sized businesses are long since recovered.
Big part of your business, right?
It is, about 60% of our business transient. That is long since recovered to pre-pandemic levels. The big multinationals continue to recover steadily, but they're not quite back.
What about China?
China, mainland China has fully recovered. Greater China is getting dragged a bit by Hong Kong, which has not fully recovered. But again, most of China's recovery has been driven by domestic demand. In April, total airline capacity for cross-border travel was only about 40% of what it was pre-pandemic. As that airline capacity continues to recover through the back half of the year, we expect lots and lots of upside.
Are some of these trends in the U.S. in terms of RevPAR, revenue per available room, and even China, is that sustainable into the back half of the year?
We think so. When we look at it now, the one caveat is most of the questions I get about demand patterns sound something like, given the interest rate environment, given inflationary environment, given talk of recession, aren't you worried? We don't see it in the data yet. The one caveat to that is for the transient component of our business, our booking window is only about 21 days. So that could shift a bit. If you started to see some real weakness for the consumer, weakness in consumer confidence, that could shift a bit. One of the things that does give me confidence, however, is the strength of our group demand. When we finished up the first quarter, we looked at U.S. group demand. For the remaining 3 quarters of this year, total group revenue is tracking up about 26% to where we were.
A lot to digest there on the travel picture with Marriott International CEO Anthony Capuano. Well, coming up, we recap the top stories, we should say, of the day and get you set for what to watch tomorrow. Stay tuned.
Sotheby's is known for generating eye-popping sales across a range of ultra-rare art, luxury goods, and property. The streetwear and modern collectibles arm of the business is now the platform for the sale of what it's dubbed the Dynasty Collection, which consists of one Air Jordan shoe from each of Michael Jordan's 6 championship-clinching NBA Finals games. Yahoo Finance had the opportunity to go hands-on, with white gloves, of course, to discuss the shoes once worn by His Airness.
What's going on, everyone? Yahoo Finance here with Bram Wachter, who is Sotheby's head of streetwear and modern collectibles. Talk to us about your segment within Sotheby's. What type of growth have you seen?
So Sotheby's Luxury as an overall did over $2.3 billion in sale last year. Streetwear and modern collectibles did about $50 million, and in our offerings, about 90% of the lots were sold.
Who are the buyers that you hear from and the interest that you hear from as well?
Our buyers typically are younger, so they typically range 20 to 40. They're sort of titans of industry, so usually successful in finance, successful in real estate, advertising, marketing. They have either a passion for sports memorabilia, collectibles, or they just have a passion for dead stock sneakers.
So say I did walk in off the street, I saw this exhibition, I said, Bram, I want to purchase, like here and now, today. How much do I need to be ready to potentially pony up?
Obviously, we've got 6 unbelievable sneakers here, and so, the sky's the limit. We've noticed that in terms of sports collectibles, over the last year, even given the economic turmoil, at a high level, the market is doing really well. We sold, less than a year ago, Michael Jordan's jersey from Game 1 of the 1998 NBA Finals for $10.1 million. Shortly thereafter, we sold a LeBron jersey from Game 7 of the 2013 NBA Finals for $3.7 million. And then we later sold a Kobe jersey for just about $6 million. And so what we're seeing is for the highest end collectibles, for the best sports memorabilia, and really the most iconic moments of different athletes' careers, the market really has been quite strong. And we haven't seen really a sign of that slowing down.
What is closing time here at Yahoo Finance? Here's a look at the biggest stories of the day. Apple unveiling its long-awaited headset, the Vision Pro. It's Apple's first major product launch since 2014, but it comes with a very hefty price tag, just about $3,500, and it will be available early next year. The tech giant also announcing a lineup of new Macs and a new MacBook, leveraging its new chips. It also showed off new software for its Watch, iPhone, and FaceTime for Apple TV.
Bitcoin sliding below $26,000 as crypto exchange Binance was hit with a lawsuit from the Securities and Exchange Commission. The SEC hitting the company and its founder with 13 charges for security laws violations, alleging that the company illegally served U.S. customers and mishandled customer funds.
And finally, oil prices edging higher on the day on the production cut from Saudi Arabia. Over the weekend, Saudi announcing it will reduce output by 1 million barrels per day. That's the biggest production cut in 10 years. It came on the heels of the OPEC Plus meeting in Vienna, and the cartel did not make any changes to plans for its cuts for the rest of the year.
That'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell. Have a good night.